the Strategic Treasurer Podcast, your source for interesting Treasury news in your car, at the gym, or wherever you decide to tune in.
Reducing tax liability is one common objective of many organizations. Another increasingly common objective is to exhibit corporate social responsibility. This can come in a variety of forms, including the support of ESG projects related to affordable housing and renewable energy. Listen in as Craig Jeffery of Strategic Treasurer interviews George Strobel of Monarch Private Capital on not only how these vehicles work, but also when they make sense to pursue.
Welcome back to the Treasury Update Podcast. I'm here with George Strobel on our second podcast on taxes. This one, we're discussing how to understand when tax equity investments matter. Welcome back, George.
Thank you, Craig. Looking forward to it.
Great. So we're going to focus on tax equity investments, but before we do, I was wondering if you could expand a little bit on the topic of corporate social responsibility, CSR. This is, tax equity investments can be intellectually linked to CSR, and in many ways they are, but could you give us a high-level overview of what CSR means and maybe some examples?
Yeah, so a number of companies have various what I'll call ESG initiatives, and so that's environmental, social responsibility, good governance programs out there as a part of their overall corporate scoreboard, if you will, for how they're performing. And this is really brought about where corporations are taking hold of the notion that their responsibility just isn't to shareholders, it just isn't to employees, but they also have an important responsibility to serve the communities and where they exist. And so often that takes the form of trying to generate affordable housing for communities, providing scholarships for kids, for educational opportunities, and just doing things that the public sector, for whatever reason, is struggling to achieve on its own. And it could just be overall charitable giving for that matter, but it's a notion that corporations have a responsibility to better the communities around them beyond merely providing jobs and making profits for their shareholders.
Yeah, George, so you use the abbreviation ESG, and I had mentioned CSR. These are pretty equivalent terms, just used in different ways, or is there a clear distinction between CSR?
Yeah, I think they are very equivalent terms. They're just the latest buzzword. They are basically the same concept. You'll see them slightly differently. The only difference is an ESG also involves the governance provisions of the corporation itself. There's a debate about, for example, whether a company should have the same president as the chairman of the board. Those kinds of notions would be involved in a CSG type notion, or equivalent voting rights, that kind of thing. But generally speaking, the two overlap otherwise almost 100%. A different buzzword out there that you will see out there that is slightly more focused. You also see some companies that have carbon footprint initiatives, which could be a part of both a corporate social responsibility initiative or an ESG initiative, but a carbon footprint initiative obviously would be one focused on generating fewer carbon emissions as a result of the operations of a particular business.
So now let's get into tax equity investments. I think most of the listeners are very familiar with Treasury. Some are familiar with tax. These things come together in different ways. But when you think about tax equity investments, how should we think about them? How would you describe that to someone?
So tax equity investments, very simply, are investments in activities which are governmentally sponsored. In other words, there has been a governmental initiative through the tax code, whether it's a federal or a state tax code, to incentivize a particular activity to basically create a public-private partnership, if you will. And this is very important because these kinds of investments can create two separate benefits to a company. Number one, it could satisfy certain corporate social responsibility goals that a company may have. And number two, it'll generate cash flow, reduce effective tax rates, and higher earnings for a particular company, largely basically not requiring incremental investment dollars, but simply taking the dollars that have already been allocated for making tax payments and instead of deploying them by writing a check to the IRS, you would make a tax equity investment with those same dollars, and you, generally speaking, satisfy your tax liabilities at the same time as you're generating actual returns on that investment, as well as satisfying other social needs in the community.
George, in our first podcast, we talked about tax credits, and that was listed as a subset of tax equity investments that was, more easily transferred than some of the heavier investment, larger capital activities that also fall under tax equity investments. How do you distinguish between those two?
So, in the context of the conversation we've just had, I really don't. They're both tax equity investments. Obviously, some of them involve investing in limited liability companies. Some of them, acquiring certain tax credits can be done simply by acquiring a particular transferable credit. Most of them and most substantive programs involve investing in an LLC. So it's something that is purely beyond the sole scope of a tax group, and it requires involvement of Treasury. But at the end of the day, both of them work relatively the same way. You're effectively using dollars that would have gone to paying taxes to instead going into funding a program that's generating some social benefit that the government has deemed important enough to create a tax incentive in the form of a tax credit for.
So could you give me and the audience a bit of a tax equity investments primer? And what I mean by that is, I know you talked about the different participants in some of these tax equity investments, and you talked about the capital stack. Who are those participants, what they do? Maybe you could just go through about the parties and their role.
So just to back up a second, so let's say you had a classic example, it's kind of an easy one to look at, is let's say you had a historic building that wanted to be renovated. Well, absent some sort of incentive, most developers are going to want to tear the building down because in most instances it's cheaper just simply tear a building down and rebuild it rather than refurbish it. So the government says, no, we want it fixed, we don't want it torn down. And it may not be on the property tax rolls. There could be all sorts of issues in the area because of buildings needing to be refurbished and put back on the property tax rolls. And so, both at the federal level and the state level, there may be a tax credit incentive offered for dollars spent refurbishing a building and keeping its core historical visual presence. And so there's certain criteria that they would, if you go through and follow these criteria, both the federal government and the state government would award you a credit for fixing that building. Well, most developers don't pay taxes. They have plenty of depreciation write-off, or they have, and when they have gains, they can, in the real estate area at least, they can use what's called a 1031 exchange and not pay tax on that gain. And so, they're like our president. They don't pay taxes currently. What the developers need is a structure that allows them to pass this credit on to somebody else, because it doesn't do them any good if they're not paying any tax. You don't need a tax credit. So, so what happens is and legislatures are aware of this, and so they create these credits in a manner such that they can be allocated to other participants in the LLC that is renovating the building and owns the building and renovates it. So you'll have the first party will be the one party involved will be the sponsor or owner of the project. They'll be the managing member of the LLC, or if it happens to be a limited partnership, they would be the general partner, but they're almost always an LLC in today's world. And that party might put in, 10-15% of the capital necessary to do the build. The credits coming in could be anywhere from 15 to 50% or more, possibly, of the capital necessary to do a project, and the balance would be third-party debt from a financial institution, a bank typically, but it could be some other types of institutions, and they'll come in, and depending on the kind of tax equity project, if it's a historic project, they might fund 65-70% of the capital stack. If it's a low-income housing deal, that may be as low as 0 or 10% debt on the project. So it just depends on the type of project, what the magnitude of each party's investment is relative to the others. And then where you will see firms like our firms is that we are the ones that kind of align we kind of provide the bridge equity, or the bridge tax equity is really the way to look at it. We provide the commitment up front to a sponsor owner that we will either make the tax equity investment ourselves, or we'll find somebody else. And so we'll invest up front and kind of bridge while the project's being planned and constructed. We'll bridge the necessary tax equity part of the capital stack with the sponsor until we line up the actual tax equity investor. At that point, we get taken out of the equity stack, and the tax equity member replaces us. That ultimately wants the tax attributes. And so you can refer to us as a tax equity sourcer or originator, or other people refer to us as a syndicator or a broker, perhaps. And all those terms are all used interchangeably.
Right, facilitating that activity between parties. Now, George, a corporate tax person or a treasurer can look at this and say, maybe this is a new concept, or does this make sense for my organization? How would they know if this makes sense? And what I mean by that is there some kind of checklist? Do you always have taxes? Is it for a period of time? What are the right questions they should be asking and answering to see if this might make sense for their organization?
Correct. So it's going to make sense, and kind of where it really, to our thinking, it really makes sense for a company that's paying tax. So we kind of use that as like triage question number one. Do you actually pay tax to a federal or state, income tax to a federal or state agency? And some of these opportunities also can offset premium taxes for insurance companies. But I don't want to say ignore that. I mean, that's a big part of it, but let's speak in context of income tax for now. And so the question is, do you pay income tax to the federal government or a state government that you could utilize either a federal or state tax equity investment through a credit or otherwise? And then the question really comes down to how, is it of a significant magnitude? What kind of savings is required? Or you have to ask the question, we have one of these CSG or CSR initiatives. We want to make this investment. It really doesn't matter what the size is, but we want to start we feel obligated to make this kind of investment, or we want to make that kind of investment. So it's kind of motivated by one of two tracks. One, I want to generate a certain amount of tax savings from it, or two, I want to be involved. I want to have a certain level of capital investment on activities that meet my my corporate social responsibility initiative. So what we would then see is from a tax side or pure financial side, treasury side, if you will, we'd say, what's the minimum savings I need? Is it 100,000? Is it 1 million? Is it 10 million? What is the number? And then you look at your size of your tax liability, and do I have a large enough liability where I can get that kind of savings from the investment? And then you kind of look at the question of, are my earnings or tax situations smooth, or do they go, are they fairly unpredictable? Do they go, they're big one year, really, I have a loss the next year, that kind of thing? Because that dictates then the duration of the tax equity investment that you're willing to make. Many of them can be done in simply 1 year increments. The results are all in the initial year, in which case, or substantially all of the tax results are in the initial year, in which case it's just a 1 year type phenomena. Others involve a series of credits over 5 years or a longer 10-year period. And so that would then tend to size the level of investment you would make. They would be bigger investments, but you would want to put more cushion room in terms of your ability to absorb the tax attributes coming out of those investments. So those are kind of the criteria that you would look at. And if I would digress, this is not a new concept. There are hundreds of public companies that make these kinds of investments. You can spot them. They're reported a lot of times in the tax effective tax rate paragraphs of public companies' financial statements, where they explain why their effective rate is a particular rate. And anytime you see a company with an effective tax rate below the statutory tax rate, so if you saw a company in today's marketplace that had an effective tax rate below 21%, ignoring state taxes, then you would suspect that they're probably making tax equity investments, and you can find proof of that by looking at the footnotes of their financial statements. But there are hundreds of companies that make these kinds of investments. It's across almost every industry. Historically, you see these the most in insurance companies and in banks. You see them in banks because some of these tax equity investments satisfy their what's called Community Reinvestment Act requirements, otherwise known as their CRA requirements, which is a statutory obligation that they have to make investments in a certain amount of investments or loans in the lower income portions of the communities in which they serve. And so a low-income housing investment, for example, will satisfy those legal obligations under the Community Reinvestment Act. On the insurance side, insurance companies have historically been the largest state investor because many of the state credits that are out there will offset premium taxes that insurance companies pay. And it's kind of a no-brainer for them because premium taxes are a sales tax to an insurance company. And so it doesn't matter whether they're profitable or not. All that matters is, are you selling policies? Are you still in business? And then at that point you say, yeah, I need those credits. And so that's why insurance companies have been very consistent investors, tax equity investments.
For the insurance companies, is it also true, or is there a matchup too on the liability side, the asset and liability side? They've got policies that may pay out over time and can take advantage of that.
Well, so that's twofold. The insurance companies so you're hitting on two things. Obviously, one of its shape, they don't want to buy more credits or attributes than they can use. On the other hand, it's a sales tax, so those numbers don't generally go up quite as much. Or I shouldn't say, they don't have the same kind of variability as actual income, which is a function of a number of different things. Likewise, insurance companies like to make longer-term investments. They have a lot of capital, particularly life companies have a lot of capital that they need to invest over longer durations to match the exposures that they have to their policyholders. And so they like 15-year investments or 10-year or longer investments. And so a number of the low-income housing credits are basically a 15-year investment, and the yields are calculated. They can get if they can get a 5.5% yield and they're paying policyholders over a 10 or 15-year period, they think that's a great win because that's the margin they need with respect to their policyholders' premium payments. And so that's an attractive investment for them. And they're looking for, typically like all businesses, they're relatively understaffed, so they like the longer period investment because it's a bigger investment, it's a bigger chunk of money invested. They would prefer to make one big investment versus making 10 small ones. And so that's why low-income housing credits are particularly attractive for many insurance companies.
Yeah, let me take you back to a comment you made. I wanted to follow up on that. You mentioned that there's hundreds of companies using tax equity investments, and there certainly are across a wide spectrum of these options, from the housing to energy, carbon, et cetera. Now, there's multiple thousands that aren't, and some of them, may have been not profitable, so they're out of it. But there's what's the size that makes sense? Nobody's going to do this if they're saving $10, or unless it's all for ESG. But what is the typical minimum size, and what might represent the upper end for some of these examples? And I'm saying beyond there's this level of, if you have $1 million of tax, obviously you're not going to buy more than $1 million of tax credits. But what's a typical range where it's the sweet spot? It makes sense to look and explore these type of options.
So on the federal side, and I kind of will depart, at this point juncture between the two. On the federal side, you see 2 or 3 million is kind of the lower level for most corporations that look at it. Although we've had some do smaller, but 2 or 3 million tends to be, the small point that people will look at it. And then you have investors 100 million or more that they're willing to take. There's companies there are big financial institutions that acquire 500, 800 million credits a year. They're obviously very big Wall Street companies, but they do it. And so there's not really an upper bound. It's just a function, and they're doing it purely for tax savings. Those large financial institutions. But having said that, it's just a function of your size of tax liabilities and interest in the area. But kind of a couple million is probably the floor on the federal side. On the state side, it's pretty simple because some of the state credits involve very little effort and are pretty easy to execute. And we don't require a whole lot of due diligence. We see corporations come in for as little as 100,000 of them on the state side. Your liabilities are going to be less on the state side, but some of the state credits are really pretty simple to get involved with. And their certificate, you're basically buying a certificate or something, and that could be 100,000 or less. So that's kind of how that goes.
That's pretty helpful. Now, the return. When you think about the return, there's two things we talked about: the corporate social responsibility, or the other term that we were using. There's that aspect, and there's also a financial return. A corporation can say, I want to do this, and I'm letting my employees do volunteer work. I'm giving money to someplace that builds housing, or I make these investments. What and how are organizations looking at this? Is it a combination of financial return and meeting our requirements? How should we look at that?
Well, it really depends on what's the driver for the whole analysis. We get inquiries, for example, from a Treasury group that's responsible, for a corporate social responsibility initiative, and those people are usually separate from the other Treasury people in a company, and they're the ones that say, okay, we have X dollars to deploy, and we'd like to deploy 30% or 60%, some number like that, of those dollars in a tax equity investment. And so that works. On the financial side, though, the more typical, and that's more unusual right now because there aren't that many programs that are just driven by pure social responsibility initiatives. Otherwise, driving them is some sort of return on these financial return on these investments, and basically maximizing your tax dollars. You've got tax dollars that you're going to spend, and so the question is, do you get a return on those dollars, or do you just write a check to the IRS and wave goodbye to the money? And so from a more astute financial perspective, you say, no, I'd like a return on my tax dollars, or a direct return on my tax dollars, other than simply good governance from our country. But the returns you typically see with solar, renewable energy, or for historic tax credits, you typically see after-tax return on investments of 13, 15%, somewhere in that range on your investment. Can be less, could be more. But that's just kind of what I'll call kicking down the narrow path of the very secure, very safe kind of perspective. That's the returns you kind of expect on those kinds of investments, and the returns tend to last for 5-6 years, but you get your money back really initially from the tax attributes in the initial year, and then your profits come in the successive years, and typically the investments last about 6 years. Returns on low-income housing credits tend to be yield-based. Sometimes they are just extreme; they don't make any sense at all. But a lot of times it's like a 6% investment, 5.5% return over a 15-year period, which most companies would say, "Gee, I don't want to do that unless I'm an insurance company." And then it gets even worse in that a bank may bid up the pricing because they need the credits in a particular county or in a particular place, and there are scenarios where they've paid par for the credits, over a 15-year investment, because they are in desperate need of those credits for legal purposes. So the pricing on federal low-income housing and state low-income housing returns can get low, but particularly on the federal side, not as much on the state side, but can get really, really low given the duration of the investment. We generally, for a company that's not a bank or an insurance company, we would never show them a low-income housing investment. Instead, we would show them a renewable energy or historic renovation portfolio to look at, and that makes far more economic sense to a typical corporation.
Yeah, more favorable. Now, that's interesting. So I think you've been mentioning that most organizations are looking at a balance of the social responsibility requirements they have and getting a good return. Some are focused on the return and achieving that through the tax equity investments. And others, I know an example of a large search company wanted to be carbon neutral in their, with their footprint, and they had massive amounts of data centers constantly growing, both for search, for storage, et cetera. And so they did all kinds of renewable energy across the board, but their key driver was they had to be carbon neutral, and then they wanted to do it as efficiently as possible. And so they leveraged many of these. That was my first introduction to this a little over 5 years ago, seeing that be the driver and then trying to optimize within the parameter of the social responsibility of being carbon neutral.
Yeah, so a lot of companies, for example, let's say you had a carbon neutrality initiative that you have, what you find is that even if you put solar panels on your rooftops of all your facilities, you find you're not generating enough energy to actually be carbon neutral. And so what they'll then look for is other tax equity type investments that they can make, that they can get credited for the energy being produced at a particular facility, which can be arranged. That's not a problem, and it's very quantifiable exactly what's being produced. And so you make those tax equity investments to help achieve the desired carbon footprint reduction or impact, whichever it may be.
So for those interested in learning more, Strategic Treasurer and Monarch Capital have created a visual guide that steps into some of the details and explanations of tax equity investments and tax credits. You can find those at both of our websites at strategictreasurer.com and monarchcapital.com. George, thank you for your time discussing tax equity investments on today's podcast.
Thank you, Craig, for inviting me, and everybody will be happy to entertain questions and see you in person at the AFP conference in Chicago this year.
Thank you, George.
You've reached the end of another episode of the Treasury Update podcast. To receive Treasury insights and helpful resources, sign up for our newsletter at strategictreasurer.com.